And welcome to another episode of The Bull and the Bear. I'm your host, Matt Clark with moneyandmarkets.com. Glad you're with us on this Friday. It's been an interesting market week, to say the least. We won't talk too much about that, but because we have some specifics we want to get into. First off, just to kind of remind everyone, you can listen to the Bull and the Bear podcast on Apple Podcasts. We're also on Google Podcasts. We're on Spotify. We're on iHeartRadio and a wealth of other podcast syndicators. So whatever your podcast listening venue of choice is, make sure to check us out and subscribe. Subscribe, leave us a review, leave us a comment, leave us a question, anything like that. You can also watch this podcast on YouTube. Just go to youtube.com and do a search for the Bull and the Bear podcast, and you'll see us. You'll see us right there, plus all the other videos that we do. We do a week ahead video that comes out, so we kind of give you a look at what Wall Street has planned for the week ahead. We do that as well. In fact, that one is already up for next week, so by all means, go and check that out. If you have any comments, questions, concerns, anything like that, something you'd like one of us to address or all three of us to address, you can email us at thebullandbear@moneyandmarkets.com. I'll try to put the email address down here and in the video so that you can do that. Also, you can check the show notes and it'll be there as well. Subscribe button for YouTube is down here in the corner. You can just click on that. Love all the people that have subscribed so far and all the feedback that we've gotten. So keep that coming. Today, we've kind of taken an approach here on Fridays to discuss particular sectors and stocks within those sectors, and this week provided a very interesting opportunity, and the reason being is that for the longest time, tech stocks have kind of ruled the roost when it comes to the stock market. They have weathered the storm of coronavirus. They were strong in the bull market that we had for the last decade plus, and they have up until recently have done very well even amid economic situations and the coronavirus stock market roller coaster that investors have been riding on. Of late, however, we've seen the tech-heavy Nasdaq start to drop off a little bit. The Nasdaq was kind of leading the main market indexes in terms of growth. It was beating the S&P, it was beating the Dow, it was beating the Russell 2000. But of late, that it's kind of scaled back a little bit because investors are seemingly taking profits on their tech stock buys from earlier and going into other cyclical industries, things like that. Also, California is implementing some new lockdown measures because of the coronavirus spread. And the reason why that's significant, some people might think, well, what does that matter? You have to understand that Silicon Valley is it's in California. And so when something like that happens in California, it impacts a lot of Silicon Valley companies, and Silicon Valley companies are tech. So you see this broadening thought of getting out of tech stocks now, or at least selling off part of tech stocks now, because of what these lockdowns could mean in the state of California. Another factor is we've got a nice fresh set. Just when we thought it was past us for a while, and it was for a couple months, U.S.-China tensions and trade are creeping back up in the news as the president has said that phase 2 round of trade talks is not happening, and he's actually criticized the relationship between the U.S. and China. That sparked a little bit because a lot of supply chains for tech companies here in the United States are rooted in China. You take Apple, for example, and other companies like that. A lot of their supply chain is based in China. So you have that kind of pressure, you have that kind of headwind, and it tends to take its toll a little bit on tech stocks. Does that mean it's going to last? I would say no. Perhaps Charles Sizemore, contributor, and Adam Odell, our chief investment strategist, may disagree, and I'll certainly open the floor up to them to talk about that. But I don't think that's going to happen. I think this is a momentary thing here, and I don't necessarily see tech stocks falling off the deep end and going off of a cliff, if you will. I think it's just a momentary thing, waiting for perhaps other indexes and other sectors to kind of catch up a little bit to the pace that tech's been going. And then I think you're going to see, once that happens, tech stocks, reclaim their leadership position. And I know Adam has talked about this to his readers before, and I think his insights are well founded. So I do want to bring in Chief Investment Strategist Adam Odell, as well as Money Markets contributor Charles Sizemore. Both welcome to Friday. And, as we talk about tech stocks, tech has been strong. There's no question about that. It's really kind of led the market, if you will. And I guess first, Charles, give me your take on this recent kind of drop off. And drop off is, I think, a little bit strong to suggest. But give me your take on the performance of tech over the last week or so.
Oh, sure. Yeah, tech has had its, I can't really call it a correction, but a pause, if you will. This is a breath. It stopped to take a breath. So we definitely have seen tech, take a breather here over the past week or two, and we've been expecting it for a while, but it never happened. Tech had just been ripping higher. It was ripping higher for the last 10 years, but particularly after March, it's gone parabolic. So I definitely expected some sort of pause. It looks like we're getting it now. I do tend to agree with you, though, that this is probably not the end of this overall theme. And why would that be? Well, as Microsoft CEO Nadella said a few months ago, and I'm paraphrasing this, and I'm going to butcher his quote, but it was something to the effect of, we've had 5 years worth of tech adoption happen in 2 months. The virus crisis and the response to it has created this incredible incentive to digitize everything, to virtualize everything, to just revamp all of your processes, to make them more amenable to working from home, to make them more amenable to working remotely, to just making life continue even in a period of social distancing. And that matters because look at the news. The coronavirus this is not over. It's raging out of control now. So as you mentioned, California is already kind of going back under lockdown. We're just waiting for the guillotine to drop on us here in Texas. We're just all assuming that we're going to go back under lockdown any day now. We'll see. And even if you look beyond the U.S., around the rest of the world, it's outside of Europe. It's really the same story. Europe seems to have this under control for now. For now, being the key words. Latin America does not. Much of Asia does not. Russia does not. It's still ripping through most of the rest of the world. So the impetus to the trends that made the tech stocks do so well since March, those trends are still in place. And even once this crisis subsides, and it eventually will, it's not going to be like this forever. We're not going to go back to doing things with pen and paper. We're not going to go back to having things be overly cumbersome. Once you get used to the efficiencies introduced by technology, you don't go retrograde. There's no reason to. So I would be a little bit concerned about hardware tech, simply because, as you mentioned, trade tensions with China are bad right now, and I don't necessarily see that getting better. I feel like we have seen the high watermark of globalization as we know it. I think for the next several years, really for the foreseeable future, you are going to see really this new Cold War. It's not, we're not going to fight China with bullets or nukes or whatever. It's not going to go down like that. But our nations are not friendly right now. And so you're going to see supply chains retrench and go back behind national borders. That's not reversing. So I would say tech that focuses more on services is definitely the better trade, and I see that trend intact.
Adam, do you see kind of the same things in your analysis that this is a momentary blip for tech, or do you see this maybe expanding a little bit longer, as it might take a little longer for the rest of the market to catch up?
Most likely momentary blip. To kind of give the backstory, technology is a unique sector. It's a unique word, even in the sense that of the 9 or 11 major U.S. sectors, technology is pervasive through all of them, really. So there's not really just one technology sector. Certainly there are companies that are solely technology or mainly technology. But you have basically when you say technology, it's hard to bet against technology. If you're betting against technology, you're basically betting against innovation. You're betting against progress. So that's kind of a hard bet to make in America or even across the world. So you have technology innovations in finance. You have technology innovations in the materials and energy sectors. You even have it in the consumer discretionary sectors to some extent, as far as how we, interact with the digital world. So, technology has had a leadership position for pretty much this entire past decade for this current bull market. And, I will say, in full disclosure, I run a service called 10x Profits, where we basically are we're either long the market or we're short the market, one of the two, based on what my model says, as far as, whether we want to be risk on or risk off. And years ago, I decided, rather than choosing the S&P 500 or the Dow Jones Industrial Average or the small cap Russell 2000 index, rather than choosing those ETFs as our main in the market, risk on ETF, I chose a 2x leveraged Nasdaq 100 ETF. So basically, when my model says that everything is clear and that we want to be invested in stocks to participate in that bull run, we buy one simple ETF. That ETF is 2x leveraged Nasdaq 100 stocks. So basically, it's the tech-heavy stocks. It's Facebook, Apple, Amazon, Netflix, Google. So, in full disclosure, my subscribers right now are long 2x all of the things because we are in risk on mode right now. And that's a great trade during a bull run. I mean, for instance, we got a buy signal on that trade in mid-January of 2019. We held that trade until we were able to take 100% profit in late February, right as the market started to peak. So that was a 13-month trade, 100% profit in an ETF. But it was in a leadership position because tech stocks have been leading all other types of stocks in the U.S. That said, I've seen some concerning things in the tech stocks recently this week. You can see it kind of like just with your eyes, but I wrote about this this week to some of my subscribers in Cycle 9 Alert. Basically, we took some profits. We took 3 trades off of our books for pretty large profits because I see the higher probability of a pullback starting. It's not really pullback territory yet, but what I'm seeing is that this week's price action creates what's called either an outside bar or what's also called a bearish engulfing candlestick pattern. And I wrote about this because this was really one of the first patterns I learned to trade like 15 years ago when I was trading foreign currencies for a prop firm. And basically what it is, it's a very strong signal of a change in the predominant sentiment of the market and who's in control of the market trend. So for the past several months, the buyers have been in control. Anybody that's been bullish the market has been buying stocks and bidding up the prices higher and higher and higher. They've been in control of the bears, so to speak. So what happened this week is that, just as we've done in recent weeks, the stocks started making new highs. And so when we make another new high during the week, you think everything's just business as usual, that the bulls are still in control and that people still have buying appetite. But then what happened is a reversal intra-week. So we're likely going to close the week lower in NASDAQ 100 stocks, probably most indices. And the other important thing about this pattern is that the range of this week, the high to low range, it fully encompasses the high to low range of last week, meaning that we have a larger range of prices. And that just shows that there was a really large swing. Within 1 week's time, there's a change in sentiment from buyers being willing to bid up prices to new highs to suddenly prices closing lower toward the lows of the week and even lower than last week's low. So that doesn't mean that we're destined for a pullback. But it does kind of indicate that the odds are growing, that we'll have something of a pause in the price momentum and something of a pullback. The other thing to note is that we're getting what we'll call divergences. So typically when you see one market index make new highs, like the NASDAQ 100 has, so tech stocks are making new highs basically over the past month or so. The S&P 500, the Dow Jones Industrial Average, the Russell 2000, Chinese stocks, emerging market stocks, those have not quite made new highs yet. So really what we want to see for confirmation that the bull market continue higher is those other indices making new highs along with NASDAQ 100 stocks. If it's just NASDAQ 100 stocks, that means that the market is thin and it's really not supported by a wider range of stocks. So that's kind of what I'm concerned about right now. It could be a momentary blip. It's something to keep an eye on. It doesn't mean to sell everything, but as always, follow the systems and just keep an eye on it.
Very good. Now I want to go through kind of a quick fire round here because I pulled, as I have the last couple of podcasts, I pulled 3 stocks. They are all tech stocks and they are all names that you likely know. In fact, at least one of them everyone knows, and the other 2 you probably have a pretty good idea of. And I want to kind of go around the room, if you will, and get your takes on them. The first one is, the one that everybody knows. It's the one that is a household name and has been for quite some time. Bear in mind, this company started as a retail bookseller and has now grown to the largest online retail powerhouse in the world, and it's expanded into cloud infrastructure and all sorts of things. A very diverse company that is very rich in terms of share price. And that's Amazon.com, Nasdaq, AMZN. It's kind of with Apple and with other FANG stocks, it kind of marches to its beat, and tech stocks tend to follow. So I'll first get to Charles, your thoughts on Amazon.com briefly.
Sure. I love Amazon. This is, to me, is a stock that there's the short-term picture and there's that forever picture. There's a very, very small number of stocks I would ever say that you could probably just buy, drop in a drawer, and forget about for 20 years. Amazon is one of those. I think once the history books are written, Jeff Bezos is going to be considered right up there with Carnegie and Rockefeller and the Ford. The great American capitalist. Bezos is going to be on that Mount Rushmore of capitalism. If they ever carved one, his face would be on it. So I love it. They basically invented internet commerce as we know it today. They invented cloud computing as we know it today. What are they going to invent next? I don't know. That said, I wouldn't be in a hurry to buy it right now. I might wait to see what happens with this little pullback, see if we get a better entry point. If you're wanting to initiate a position, I would say maybe average in. But this is one I'd be very comfortable owning, not just now, but really forever.
Adam, what are your thoughts?
Yeah, so I have a hard time betting against Amazon as well. It's clearly dominant, clearly has a great track record. The thing is, I like Charles, would not buy it right now. My Cycle 9 system, which identifies trend and momentum moves over a 2 to 3 month period, gave a signal on Amazon in February, late February, basically as the market started to roll over because it wasn't rolling over as badly. So that trade is now, that ended up, a profitable trade, but that trade is now over. So what that means is that the next 3 months are basically average odds or even lower than average for Amazon rather than buying it in late February. As far as my longer term view on Amazon, again, it's hard to bet against it. On my longer term 6-factor Green Zone Fortunes ranking model, Amazon rates 85. So it gets a low score on size because it's a huge company. It gets a low score on value. I mean, there's 87% of the market that's a better value than Amazon right now at current prices. But at the same time, its momentum, its low volatility, its quality score, and its growth score are all in the 90s. So overall, it rates 85 out of 100 on my longer term model. So, it really is hard to bet against Amazon. The thing is, if you own a Nasdaq 100 ETF like QQQ, or if you're in my 10x profits trading service where we own the 2x leveraged version of that, you own shares of Amazon. Okay, so you're owning 100 tech stocks, including Amazon. You may even own it 2x leveraged if you own the 2x leveraged ETF. So, my opinion is I'm happy to own a little bit of Amazon through the ETF. I don't necessarily need to own shares outright. So that's my take.
And that's kind of my thought. To me, Amazon is just expensive. It's a very pricey stock. It's a great stock to own. It's a great company to invest in. I think it's a good, buy and hold type of a company to have. It's just its entry point is extremely expensive. So I kind of agree. I think Charles kind of hit it pretty good in saying that, maybe we find a better entry point as things start to, continue to subside a bit. But overall, I agree. It's very hard to bet against a company that has the track record that Amazon has. Moving on to our next company. This is one that has been a hot stock since the coronavirus. This has been since March. This company has taken off and flown. It's been massive just because of the coronavirus forcing millions of Americans to work from home. As you can see, the three of us are working from our respective remote locations. We're not in an official office, as you can see. It's a video conferencing platform, video, voice, chat, content sharing, all that great stuff. It also has an enterprise cloud phone system. And of course, I'm talking about Zoom Video Communications Incorporated. Trades under Nasdaq, under ZM. And this one I think is interesting, but I want to get Charles and Adam's take first. Charles, I'll start with you. What's your thoughts on Zoom?
Sure. I like Zoom. I think more than almost any other relatively new company out there, Zoom was really the right company at the right time to deal with this pandemic. We have a million competitors. You can consider Skype a competitor. I don't know, WebEx. What are some of the others? GoToMeeting. There's a million of these companies that all do, to some extent or another, the same thing, enable virtual meetings. Zoom seems to do it a little bit better than the rest. There's been issues with privacy on it. Those have already really been addressed. There's always going to be something, of course. Zoom seems to be on top of it, and their technology really is great. My concerns about Zoom are that just as Zoom came out of nowhere to sort of knock all these other rival companies off their pedestal, Zoom's kind of become the de facto. You talk about, instead of saying hey, Google that, you say, hey, let's have a Zoom. Zoom meeting doesn't even necessarily mean a Zoom meeting. It just means a virtual meeting. It doesn't even have to be, Zoom has become a verb at this point, or a noun. Both. Can you Zoom somebody? Is that a verb? I digress. Anyway, it's become an iconic company in that respect. My concern is there could be another competitor that knocks them off in another 6 months. Who knows? But more than that, the company isn't profitable. And so my view on that is, look, it's still a relatively early stage tech company. It hasn't been around that long, so the lack of profitability by itself is not a deal breaker. I would view Zoom more as a shorter term trade than a longer term investment based on that, though. I also think that perhaps we should wait and see what happens with this little mini correction we're in before I would jump in. So I like it. I probably wouldn't buy it today.
Okay, Adam, what do you think?
Yeah, so Zoom and zooming is absolutely a verb, as far as I know. Funny story, my dad is an attorney, and he specializes in mediation. So he basically, I'm from West Virginia, and he drives all over the state of West Virginia to meet in person, or has for the past several years, to meet in person with two different parties that don't want to go to a trial, and they want to try to settle their differences. So they get in two different conference rooms, and he tries to mediate their dispute. So it's very, he's on the road all the time, and he's in face-to-face meetings. And so when this, all the lockdowns happened, I was curious how he would handle that. And he's a sole proprietor, so he kind of runs his own book. And so, I was talking to my mom at one point. I said, what's Dad doing? Is he on conference calls? And she said, oh, no, he's Zooming. And so he basically figured out, he needed to adapt. So Charles's quote as far as, 2 months or 5 years worth of adoption in 2 months, I can definitely see that, at least in what my dad was doing. My dad would never have been a Zoomer had he not had the necessity to. So this, the mother of all invention is necessity, I guess. So, I certainly see how it's a hot stock right now. I see how it's, gained in popularity. It was perfect timing as far as it coming on the market just a couple years ago, and then having this coronavirus. I also agree with Charles. It's more of a trade than a long-term investment. And right now, I think the trade is over. So my Cycle 9 system gave a 3-month buy signal in early March on Zoom, and that trade is long over. So I'm seeing the same type of reversal pattern, this bearish engulfing candle in Zoom that I saw in the entire Nasdaq 100. So I definitely think we're kind of due for a pullback in shares of Zoom. Also, more of my concerns longer term. Charles touched on this. I think Zoom maybe had one profitable quarter recently, but their PDE is like 1,488. It's almost 1,500. So as far as my longer term 6-factor ranking model, it ranks 5 out of 100 on value, meaning there are 95% of all companies out there are trading at better price to earnings, price to book, price to sales, price to cash flow ratios. The other concerning factor is just the volatility in the stock. So, typically lower volatility stocks earn more longer term returns than high volatility stocks. So ultimately, Zoom rates basically in the middle of the pack. And as far as my overall model, a number of the factors are very risk factors. I think the trade is overdone. So I would not be getting into it at this point.
And I agree. I think this is becoming an extremely overvalued stock at this point. You touched on it with the PDE ratio of 1,488. The industry average, by the way, is 45. So, that's a huge discrepancy. And price of sales is at 91. The industry average is 7. Then you have the price to cash flow, 873. The industry average is 32. So yeah, I think, I recommended this back in March, and it did very, very well. I think it still has maybe a short bit of run left, but I think it's going to come to an end. If it hasn't already, it's going to come to an end here very, very quickly. So if you're in it, you might want to think about moving somewhere else. If you're not in it, maybe a good time to just go ahead and look past just a bit, because I think this is a stock who's in a very competitive field. As Charles said, even Microsoft and Google offer options that do the basic functions of what Zoom does. It may not be as robust, it may not be as strong of a platform, but it's all basically the same. It's all basically the same thing, the ability to video chat back and forth, which is what businesses are primarily using it for. Okay, moving on to our third and final company real quick. This one is another one that I recommended back in March, and it blew up like gangbusters since we recommended it on Money in Markets. This is before Adam's time, by the way, just so everyone is in full context. It has gone up about 180%. So it has been a massive win, and it's a company that you really flew under the radar. And even now, I think it's a company that is still kind of under the radar, with the exception of the fact that it's gained so much. That's what's put it in the eye of investors. Otherwise, it would be a company that you probably wouldn't think of. And it's Docusign Incorporated, trades Nasdaq under DOCU. And I'll start again with Charles. Charles, your thoughts on Docusign?
Yeah, so I love the product. I used to run my own small firm, and I had the problem of always kind of being on the road, being on an airplane, being in a foreign country. The idea of FedExing documents back and forth was really inconvenient to me even 10 years ago. I mean, I don't know how anybody still does business like that, but I mean, some people still FedEx stuff back and forth. So I tried different things. I had, tried just, hey, you could print this out, sign it, and scan it back to me. But nobody wants to do that either. And then Docusign came around. Docusign makes closing a house something you can do in seconds, clicking through. Opening a financial account, something you can do in seconds, just click through. Execute any sort of legal contract. You can just click through and you're done. It's robust. It's actually safer and more secure than people think. Oh, well, it's a wet signature. I mean, that's safe. Not really. If you sign a paper contract, what's to stop the other person from taking pages out of the thing you signed, putting in other pages and stapling it together? What's to say somebody didn't forge your signature? Something like Docusign it's an intact PDF that has a bunch of security junk. Security junk is actually a technical term, by the way. You can look that up. It's a technical term. It has a bunch of security junk embedded in the PDF so that you can't tamper with it. So if you Docusign a document, it's essentially tamper-proof. Or if somebody did tamper with it, it'd be really easy to figure that out with forensics. So anyway, I digress. Great product. I think my issue with Docusign is really the same as with Zoom. It's not a profitable company. I really think at this stage, Docusign really ought to be profitable. It's a bad sign to me that they're not. I don't like that. And I think it's probably this is probably not the best time to enter it. I would wait and see what happens with this little pullback first. I would say the underlying business still has a lot of runway left. I just think the stock might have gotten ahead of it in the short term.
Adam, what do you think about Docusign?
Yeah, I more or less verbatim see it as Charles sees it. Not profitable. Got caught up kind of as a cult stock in the coronavirus. A great product. I am surprised we haven't been doing business this way for longer. We're not going to go back to pen and paper. So, the company is going to exist, and the product or that type of a product will continue to exist. But it rates very mediocre on my model. As far as the short term, the trade is overdone. I also got a short term buy signal in March on this, but it's so far stretched from the 200-day moving average. Getting the same type of reversal signals in Docusign. So if you were in it, 3, 4, 5 months ago, take your profits and enjoy them. Certainly, it was a great trade, but I think it's done now. And longer term, I would certainly not buy it at these valuations.
Yep, it's overpriced. Its return-ons are I mean, not great at all. In fact, the return on assets, return on equity, return on investments are all in the negative at this point. And I'm kind of with you guys. At this point, you would think it would find a way to make money. I know it makes its money on subscription basis, where businesses can buy subscriptions to be able to send unlimited amounts of documents back and forth. They have a free version where you get, I think you can scan however many documents and sign how many documents you want, but you can only send 3. So I get that, but yeah, I think it's a great business. It's a great model, and it's something that is probably going to be adapted even more widespread now with a second wave of coronavirus coming back into play. Yeah, but in terms of Docusign, again, we enjoyed great gains from it when we recommended it back in March. But if you're not in it, probably want to stay back a little bit and wait and see, how this pullback plays out. So. That's kind of our take on those 3 very, very big stocks, very, very, very good stocks to analyze. They kind of cover a wide range of tech. And parting shots.
Matt, if I can jump in.
You can, sure.
If I can jump in, you picked 3 great stocks, and these are stocks that everybody's aware of. And one point I want to make is it's kind of counterintuitive, but you can often make more money on stocks that you haven't heard of or that everyone hasn't heard of than the ones that everyone has heard of. For instance, the stocks we covered today, I run a program called Green Zone Fortunes. And basically, it's a high conviction, longer term stock buys based on my 6-factor model, which includes momentum, size, volatility, value, quality, and growth. And basically, I'm able to give any stock a score from 0 to 100, 100 being best. So just for instance, the stocks we talked about today, Docusign was rated at 50. Zoom was rated 56, and Amazon was rated 85. But you're aware of all those stocks. There is one stock that I just recommended this month in that service, Green Zone Fortunes. It's a technology company, but it actually operates in the energy space. So that's what I was talking about earlier, is that technology is pervasive through all the different sectors. So this is kind of an under-the-radar company that you haven't probably heard of as much as some of the others, but it operates in the solar energy space. And whereas Amazon's rated 85, this company earns an overall rating of 93. Its technology is basically earned over 420 patents last year, more than any other solar company. And it rates very highly on all 6 of the factors. So there's really no weak spot in this stock. The solar industry, I mean, you can think what you want of it as far as being a tree hugger industry, or, I come from West Virginia, so I come from coal country. And I know that a lot of people have their livelihood tied to older fossil fuels. But if you're an investor, what you should really care about is looking ahead and looking where the technology is going. So solar, for instance, the cost of solar has come down 85% in just the last 6 years. And that's happening like basically under people's eyes. People are not aware how fast it's happening. So I think the next 6 years for solar are going to be gangbusters. And like I said, in my service, Green Zone Fortunes, which we can probably put a link in the show notes. I've just come out with a buy recommendation on the best solar stock in the industry of about 14 stocks. It earns a 93 rating overall. So again, you can kind of often make more gains on the stocks you haven't heard about than the ones that everybody's talking about.
And I think that's something interesting and brings up a whole other topic we can talk about at another time. And that is, the propensity of especially beginning investors to think of, okay, I need to look at these big companies that I've only heard of. And that's great. I mean, if that's what you choose to do, that's fine. That's acceptable. I mean, it's your trading strategy, it's your money, you do what you want. But I think there's something to be said about looking for those diamonds in the rough, if you will, or, those companies that aren't getting headlines, that you don't see TV commercials about, because those types of companies are where you're going to find those gems. And Adam talked about his services, and I'll hype it a little bit more. That's what he does. That's what he does. You're not, you might, I guess, but you're not going to see Amazon. You're not going to see, these big companies. He says, okay, now is the time to do that. He's going to be doing his research. He's going to be looking and doing his homework to see, okay, what are these hidden companies that you may not know about that have the opportunity to return you solid gains? And that's what Adam does. And to his credit, he does it very well. I think as an investor, you've got to, broaden your horizons a little bit. Don't have the tunnel vision of just trying to find a larger mega cap company that you've heard of in order to make gains, because odds are their market movement isn't going to be nearly as wide in terms of gains provided to you as some of these unknown companies that may be a little smaller in scope, but still have the potential to return and to give you solid returns. So I think that's a great point. It's a great note to end on right there, Adam. And I appreciate you bringing that up. definitely sound advice for people, for listeners of the podcast. But that's going to bring our show to a close here on this Friday. Certainly glad that you've all joined us here on the Bull and the Bear podcast. You can listen to us on Apple Podcasts. We've got our entire catalog of podcasts is on Apple Podcasts. It's also on Google Podcasts and Spotify and iHeartRadio. You can check out this episode and many others. The others we've done. This is actually our 25th episode. So of the Bull and the Bear podcast since we started about 3 months ago. So I'd like to thank everyone who has supported us during this time and continue to do so. Also, you can listen to us on YouTube. You can see the video, or if you want to see just exactly what these three guys look like, you can do that on YouTube. After you see it for the first time, you may decide that's not a good idea, but I certainly encourage you to do so. Just go to youtube.com and type in the Bull and the Bear podcast, and you'll see us right there. So that's going to bring it to a close. If everyone has a great weekend. For Money Markets Chief Investment Strategist Adam O'Dell and contributor Charles Sizemore, I'm your host, Matt Clark. And until next week, safe trading, everyone.